Hello, everybody, and good morning. Today we have the pleasure of having with us Kim Ullman, CEO of Concordia Maritime, who will go through his company's case and presentation. Concordia Maritime is a company that engages in the product and crude trade and owns many tankers, which I'm sure that Kim will go through shortly. Kim, please go ahead.
Thank you, and thanks for inviting me. Let's do a little update on Concordia Maritime. Mostly about the market, but also about the company as such, of course. Let's get straight on to it. Next slide, please. Thank you. Just to put it into perspective, I think you actually jumped a few pictures there, didn't you? That's right. That's the one. That's number 3, right? Sorry for that, everybody. Okay, so here we are. So some key facts about Concordia Maritime. It's an international tanker shipping company, as Dennis was saying. We own 12 product tankers and 1 crude tanker. And we've been listed in Stockholm since '84. And the Stena Group is the majority shareholder of 52%. Next slide, please. Yeah, our business model, simply speaking, it's about operating tankers in a daily manner, and you can do that in 3 various ways. You can do it on spot market, which means that you go from one charter to another, one cargo to another, and have to negotiate each cargo each time. And then there is a variety, and you can do a term business. The TC stands for time charter, so you can rent the tankers out for a period of time, and consecutive voyage charter is an alternative. Well, that's the main part, the daily operation. But of course, you have to make sure that you buy the vessels in a good moment and at good prices, and make sure that you buy the right vessels at those good prices, and then operate them. But then you should also, every now and then, take the opportunity to sell when the markets prevail or when the prices have gone up. And this is working very closely with the charter market as such. So the values of tankers go up and down as the spot market and time charter market goes up and down. So that's just to put it a little bit in perspective. Next slide, please. And to put it into another perspective, in where are we in the value chain? We are transporting crude oil, and we're transporting refined products. So if you extract oil from land or from the sea, and you transport that by crude oil tankers, and they are bringing it to the refinery, and the refinery makes products out of it, and we are then transporting the finished products in what we would call product tankers. Simple as that. And it goes on to terminals to unload it, and to being used in our all daily lives, as the graph is trying to show. So that's putting it in that sort of perspective. Okay, so next page, please. The ships, same ships that we were talking about before, but now in pictures. 10 product tankers, P-Max tankers, 183 meters long, 40 meter wide, IMO 2 Max class tankers, a chemical product tanker, and a Suezmax tanker. And this particular Suezmax tanker, or this particular tanker that is called a so-called Suezmax tanker, is 278 meter long and 48 meter wide, so pretty big units. Next slide, please. Okay, so that's putting the company in perspective, where we are and what we have. 2020 in short, in terms of numbers. It's being a little late now to show 2020 numbers, but you've seen it. It was a good first half, or a reasonably good first half, but a much worse second half. And all in all, it made us make a negative result of 65 million Swedish krona. We had a very heavy dry docking program continuing in 2020. But we also added some Suezmax capacity. We've chartered in ships to add to the capacity that we're hopefully going to gain from in an upturn in the market. And we have a new CFO since just a few weeks, as a matter of fact, Martin Nerfeldt. Next slide, please. Okay. 2020 was a year certainly affected by something called COVID-19. I think everybody else is going to say the same things, and this is how it affected our markets. On a macro basis, the oil demand was basically destroyed, if you will. We lost on average 10 million barrels per day in oil demand, and that's things we should have chartered or we should have shipped in our tankers had it not been for the COVID. So, and in order to meet that demand destruction, of course, the producers of oil needed to reduce the production. So we had much less oil to ship. And then on the demand side, we had hoped that Q4 would have been even stronger in the recovery of the oil demand, but we got the second wave towards the end of the year. And all of this is directly affecting the tanker market. Because it was weak because of the demand destruction, because of the cuts in production, and because of the fact that during a short period of time there was a stock build, and people started to draw from those stocks for the rest of the year, and that affected negatively the tanker market too. Next slide, please. So this business slide is trying to depict, how it has been, and we were, after a couple of bad years, 17, 18, towards the second half of 2019, we were about to see a structural upturn in the tanker market. Things were looking fine. We had an oil consumption of 100 million barrels a day. We had normalized levels of inventories, and we had that upturn towards the end of the year. You can see rates, on the left-hand axis, going from, $10,000 a day to $20,000, $30,000, $40,000 a day in this structural upturn. Then in the beginning of 2020, we had the worries around Corona. Then you see a very short spike, and that's difficult to describe, but it's got nothing to do with Corona. It's the main reason at that time was that the Saudis decided to flood the market with oil, lower the oil prices, and the oil prices went from high 60s to under $20. At that time, people started to stock up like there was no tomorrow, regardless of that demand destruction I was talking about before. People knew that, in the end, we will need this oil. Even if we can buy it for $20, let's do that. So they started to stock build. And we had a short spike in tanker rates, which is the reason why we managed to make profits the two first quarters. But then, of course, we have the demand destruction. OPEC decided, okay, let's stick together. Let's move this oil price from $20 back up to 60. So they cut production. And we were left with lower demand, lower production, and people drawing from the stocks. So you can see the Corona effects between $0 and $10,000 a day. And this is for product tankers needing around $15,000 per day on the left-hand axis to break even, roughly speaking, 15 to 16. Next slide, please. Okay, so this is what happens. This is just to show the same thing. When you have an oil consumption that goes down so dramatically and you still produce the red line, then there's a stock build, of course. And now we are at least drawing from that stock, which is good. So the production is under what the consumption is. And we're hoping that this we should clear out that overhang of stocks so that we come back into equilibrium and more oil will be needed to be shipped. I'll be back to that. So, okay, so that was just a picture showing how it works. Next slide, please. So Our ships right now, we have those 10 P-Max tankers, 5 of them on spot market right now, and another 5 is on what I called before, these term charters. The IMO 2 class vessels, these product chemical tankers, are mixing with clean petroleum products, CPP, vegetable oils, and chemicals, and have managed actually to have a ratio of 80% of the time being laden with cargo. That is Suezmax. Okay, we only have one, but we're in a big pool, or a pool that operates 25 Suezmax tankers, so we're not alone in the market, and we have added capacity in the Suezmax space of the equivalent of 1.7 Suezmaxes. Okay, next slide, please. So, summary of 2019 and 2020. Market on a structural recovery in Q4 2019. We saw that. We had 100 million barrels a day. We had inventories, okay. We had 5,300 tankers, utilization rates of 85 to 90%. We had high freight rates. That was in Q4 2019. Corona came, killed the market, delayed the structural upturn by some 18 to 24 months for the reasons we've been through already. And from second half of this year, we expect the market to start recovering again for the reasons I'm coming to right now. Yes, exactly. Outlook 2021, 2022. Next slide, please. The first thing we have to do is to have an economy getting back into shape. Let's hope that this is going to be the graph that's going to prevail for this year, where IMF and most of the analysts are looking at a recovery in the world economy in the size of 5-ish%, which is a very good base for the next slide, because the next slide is maybe the most important slide. If you look towards where we are, if you can see the estimate in shaded grade area, January 2021, the oil consumption, the red line, is on its way up, slowly but surely, in this recovery phase. And we believe that towards the end of this year, we are back to almost where we were in this famous Q4 2019. So the oil consumption is slowly growing, and you can see on the right-hand graph that we are going to get more oil from the producing countries that is needed to be shipped in order to keep the inventories at an equilibrium. Before that happens, next slide, please. We need, as I said, to get rid of the inventories. We need to close that gap. It dramatically built up during the last spring, but now it's down by 70%. And with the current pace, we are consuming roughly 1.5 million barrels a day more than we are producing, which means that this surplus should be gone by the summer. Next slide, please. So the consumption looks good. The inventories are going to be coming down to normal levels. What about the other side of the coin, so to speak, the order book? Well, we have a low order book. The only good thing with the bad market over the last number of years is that very few people have ordered new ships. So we have a relatively low order book. Next slide is showing the growth per year. So this is just converted into, we are expecting the fleet to grow by a couple of percentages. There's still a little bit of a growth, but it's only, if you will, circa 2%. Next slide, please. Putting it all together, economy going up, consumption going up, inventories normalized, we see a demand for seaborne oil transportation growth of 5 to 10%. Whilst at the same time, we see a supply of transport capacity growing by only 2-3%. So we do expect the market to come back from summer onwards. And one should know that very small changes in transport demand has a big effect on tanker rates. We must not forget the fact that even though we have had a very poor tanker market, all tankers are working. It's not like it was in the 70s when they were laid up around the world. Every ship is working. They're not working very well. They have bad charters, but they do work. No ship is in layup. So with this extra demand, put that into to the tanker demand, and you will start to see significant changes in tanker rates. And this we expect to see happening from at least from this summer. So I think next slide is giving us the fact that in an environment like this, where we see an increased market, at least we have been through a bad period, been through that hopefully soon. We have docked our ships, we have cleaned them up, we've fixed them for the second half, so to speak, of this football match. And the gray bars is describing the fact that they are in the so-called spot market and can take advantage of this market upturn that we are expecting soon to happen. Yeah, and the next slide is summarizing it all. Why Concordia Maritime? We know 2020 was affected by COVID-19. We do believe that from second half this year, we are starting to see a strengthening in the market, and we have a structural upturn in 2022 instead of 2020 as we thought before. So Concordia, well-functioning, right position vessels, and the fact that we have access to the Stena sphere is great too. So I think the next slide is summarizing it with the fact that this is the restart of the next upturn in the tanker market. From there on, it's Q&A, Dennis.
Thank you very much, Kim. That was a very thorough explanation of your view on the market and also an overview of the company. I just want to sort of get right to it. Right now, the market is in a very difficult place. Rates are below OPEX, but your fleet was able to book rates above the market. Could you maybe give us a bit of color as to why your fleet tends to outperform?
Yeah, but they are in pools together with other ships. They have a critical mass from that perspective. They are a little bit extra or different to other ships, with the P-MAX vessels being a little wider, bigger. And for those who can use or utilize that extra space, there is extra money to be made. And the fact that we have managed to be 80% of the time in a loaded condition on the IMO 2 class vessels is a big testament to the fact that there was a good design to start with. Any taxi driver would be happy to have the taxi full of people 80% of the time.
Okay, and now during your presentation, you give a very thorough and clear outline of your positive, let's say, medium-term view, because it's H2 2021. First question there is, what do you think is sort of the most imminent potential trigger for your space? And then also, if you could just give a bit of color on some of the long-term demand drivers for the tanker space investors should be looking at.
Well, short term, it is basically what I've just mentioned. We are shipping less oil than what the world needs. There will come a day. Yes, OPEC extended their cuts by another month. Everybody had hoped for more oil to be shipped in April. Okay, so we pushed that a month. What will happen during that time is that the inventories will just go down quicker. So that's fine. We will see even a bigger catch-up effect, if you will, come this summer for that effect. So that's the short term. We need to ship more oil. The world is consuming more oil than what we are producing, exporting, and shipping. So that is needed to come to an equilibrium. Long term, Long term is a difficult question, of course. Depends on what you mean by long term. Long term, in our view, is 3 to 5 years, and 5 to 10 years. I believe that there is still a need, whether we like it or not, for oil. Well, there's going to be a need for oil for a long time, but it's potentially a continuing growth in consumption and need for oil for a period of 5 to 10 years at least. Whenever that is going to be plateaued out, we do not know, and everybody's speculating on it, which is fine. But then the fleets and the tanker owners will need to adjust their fleet size so that it matches whatever the demand is. I mean, we're not producing the oil. We're not stimulating the consumption of oil, but we're transporting it for the need of the world.
And then sort of play a bit of devil's advocate. What's sort of the thing that you fear could hinder at least or delay the recovery for tankers? What's sort of the thing that you're looking out on the horizon for and hoping doesn't come?
Well, short term, it's another Corona. It's Corona version whatever, of course. Things that we cannot manage. So that's short term. Otherwise, things are looking pretty okay short term. And I'm not going to go into wars and things like that. You know, anything like that could of course destroy anything. But so short term it looks fine. Long term, it's you have the fact that politicians and policymakers, you know, could come up with rules and regulations that could be a notch or too much for us to swallow, so to speak. We cannot adhere to it, and that is a risk that it's not a collaboration between policymakers and the industry itself to make sure that we are jointly going, you know, taking this challenge together to make sure that we will make this transition into a non-fossil future in the future.
And then now, I know that those are some difficult questions, you know, looking at the long-term view, especially since some investors are a bit hesitant on working with oil, but it seems quite clear it's going to be around for a very long time, as you say. But now just sort of thinking from a strategic perspective for Concordia Maritime, what do you think, where do you think you're going to be in 3 years from now? Is it going to be secondhand purchases, secondhand sales, maybe even a new build? So if you can just give us your color on maybe M&A as well, some color on that.
Yeah, with our view on the market, I think it's certainly good times to buy secondhand. I have always been against as much as possible, you know, new buildings, because it just adds capacity, and we have had in the shipping industry a tendency of adding too much all the time. So that restraint, I'm so happy that we have the restraint in ordering new ships. So I think secondhand for the next couple of years is good. I envy, not envy, but I mean what Torm just did. I mean that's beautiful, you know. And it doesn't matter if it's 1 year old or 10-year-old or whatever it is. It's a bunch of ships, and that steel is going to increase in value. So that's definitely what we would be looking at over the next few years with this increase in transportation demand. Long term, it's more difficult. Long term, you have to adapt. You have to come up with new ships, engine types that will not burn fossil. And as you know, everybody's working on that. We and our sister company Stena is working on that, and that's one of the beauties to be together with Stena with the R&D development research company or department, that we're constantly working on this, and we need to adapt. We need to adapt for the future, that's for sure. But we have to make sure that we do the best we can with the tankers we have right now.
And then, you know, just sort of the last question, I know it's ESG related, but you just sort of answered it right now. What are some of the initiatives that you're following to sort of help improve, let's say, your profile, your ESG profile? If you could just give us some color on that, that would be great, because it's a big concern for some investors in this industry.
Yeah, no, I appreciate that, and we need to be doing our share of this, and we are doing that, and we have been doing that for a long time. Just the fact that this Detta group that owns us 52%, and they have an R&D department. They have 50 naval architects that are working day and night, so to speak, to make sure what is next, what should we be doing next, and on the existing ships, what can we do to bring down the consumption, to lower the emissions on the existing ships. Cannot kill them. We cannot go and scrap them tomorrow because they are burning fuel. That's the way it is. We have 5,500 tankers in the world, providing the world with energy. But we need to be doing as much as we can on the existing ones, and we are to as much as we possibly can to reduce the consumption and the emission on the ones. Longer term, as I said, we're working on various projects to what is next, engine wise and propulsion bunker wise as well, and that's something we're working with day and night and have been doing for a long time. And I'm not having the perfect answer to whether it's methanol or something else, but as you can see, we, or collectively as a group, is heavily into methanol as we speak.
Kim, thank you so much for your time. I think that's been quite some detailed questions and very good answers from you. So thank you for being with us today and giving a very good overview on your market view and also a good overview of your company. So thank you for your time.
Thank you.